Good morning, everybody. Good morning. It's Tuesday, not Monday. Man, I was almost off. Good morning, Mike. Jim K, nice to see you. Dr. P, did that make sense? Before I reinstall everything, I hope you're listening. Maybe you're trying to build charts right now. I'll always just try to build a new chart. If I think that I fudged a little bit on a chart and it doesn't feel right, I'll just build a new one, and that usually helps me out. And then when I compare the two, it lets me know if it was something corrupt on that first chart. So hope that one helps. Good morning, Dwight. Nice to see you. Guys, how was everybody's weekend? Hopefully you had a good one. Good to see you all back in here. I'm a minute early, so I'll slow roll into the day, guys. Let's start with Forex Factory. Let's make sure that there's no news releases coming on that are going to affect the world we live in. Um, Remember when I'm looking at news, today's Tuesday, September 10th, factory orders at 10 a.m. It's a low impact scenario. And the low impact ones, it's always nice to know where they're at, but I don't typically worry about them too terribly much. Honestly, I don't typically worry about anything too terribly much, which is kind of nice. Um, what I'm looking for when I look at news, can everybody hear me okay? Are we good? Nope. Hey guys, can you hear me now? Anybody? Do we have sound in the room, guys? Help me out. I was muted just a second ago. Do I need to reboot? I may need to reboot. You can hear me, Mark? Thank you. All right, just making sure. I talked at first and I was muted, and then I came back and said, "Can you guys hear me?" And nobody said anything, and I was so scared. Not really. We are good to go. Cool, guys. ForexFactory.com. I'm coming here every morning and I'm looking to see what news releases are going on. I'm just um, trying to figure out if there's something going on that might make the market move kind of crazy. So today is Tuesday, the 5th of September. Um, at 10 a.m., there's factory orders. It's a low impact scenario. It's not something that we're really too worried about. We want to know that it's there. But it's those red boxes, those orange boxes, those high and medium impacts. Those are the ones that can create problems that can make the market untradeable, that can make the market bounce and jump and move all over the place. So every morning, this is just part of my routine. I come in and I take a look, and I want to make sure that there's not something going on in the room. And then everything that I talk about every day, guys, I know that I have new people in the room, and I want to say welcome to you newer people. It's great to have you with us. This is the education room. I want to remind all of my new users, excuse me, that we don't call trades in the room here. That's not what we're doing. What we're doing is we're teaching you to read your indicators. And learning to read your indicators is a process. It is a foundational approach that I take to the education. And really, the first hour of every classroom is the exact same. We're going to talk about one trade. We're going to talk about what's called a high probability trend trade. I'm going to go to the tutorial section here and down to the glossary of common terms. And we talk about a high probability trend trade for the first hour because this is a trade where every indicator on every chart agrees for the trade. So we're not going to talk so much about all the things that you can do with the software. We're going to talk about the highest probability thing that you can do with the software. And when you take a high probability trend trade, each indicator on every chart is going to agree for the trade. You're going to have your strongest triggers, nothing in the way. You're going to enter the market where it's most likely to continue. And I embrace the idea that this should be your first trade because when you learn the high probability trend trade first, when you allow it to be simple from the beginning, this high probability trend trade, whoop, shoot. I'm so sorry, guys. All right, I'm back. I did a reboot. I'm not entirely sure why the market does this, and I booted everybody out. So let's get everybody back in. My apologies. I'm going to let people get back in. For those of you that made it back in quickly, I'm sorry. I rebooted. I probably should have typed in there that I'm going to reboot real quick. So I see a lot of you typing, and I don't see your names in here. Here we go, right here. Guys, seriously, sorry about that. Good morning, Nexgen, Ben. 007, I like that. Good morning, Sydney. Great to see you. Um, Discord, for whatever reason, in the mornings likes to give us a little bit of audio trouble, and I'm not sure why that's been happening lately. So I'm going to give it just a second for people to pop into this room. I think I may have accidentally booted everybody out. Um, we're going to focus on this high probability trend trade, ladies and gentlemen. It's going to teach you to read your charts, and that's exactly what we're doing. Um, the goal is to become a chart reader. The goal is to be able to open up your workspace to look at your indicators and understand that they're providing advantages and making sure that those advantages are clear. Um, Absolutely. I'm talking about termination conditions, Dwight. Absolutely. And if you have, can everyone hear me or is it just Sydney? Give me a Y if you can hear me, please, guys. All right, so let me tell Sydney. Okay, Sydney, you're in. You're good. Okay, cool. Um, where was I going with my thoughts? That's okay. So let me get back to it. Chart reading. I'm so sorry. Um, guys, you're going to be able to understand where the market is likely to continue. We're going to use those continuation points for entries for your high probability trend trade. You're going to understand where the market is likely to go by using Fibonacci, by using those trigger lines that provide momentum. You're going to be able to make intelligent choices on targets. And then finally, and Dwight, this is for you, where the market is likely to stop, you're going to be able to recognize areas that may create a bounce in the market. You're going to be able to recognize these areas that may stop the market cold in its tracks. And we call those termination conditions. These likely to stop areas, these are the areas that can shut down a trend, but these areas also behave as an anchor for what is your highest probability trend trade, the trade that typically wins 70 to 80% of the time. And that's that trend trade that happens after a termination condition, after that area where the market is likely to stop on your large chart. Is it just Sydney? And guys, I hate to keep doing this. Can you give me a Y? Okay, so let me tell Sydney then. I'm in and out. I'm not sure what the problem is with Discord this morning. Um, we're going to keep it simple, ladies and gentlemen, and that's always the goal for what I teach is simplicity. And there's a very tried and true path to get you where you want to be with the software. So this is for my newer people in the room. You guys that are coming in that have said, you know what, I like the software, I'm going to learn to read it. There's two things that need to happen for you to really get to where you want to be ASAP. And it begins with posting your trades in the class. Being able to post a trade so that we can have a conversation. If you go to your search bar, look for your TechSmith capture. Because TechSmith capture is going to be how you take a picture, and that's how you and I are going to have a conversation each and every day. Um, TechSmith capture is a very simple program. It's a giant red button, and it just says capture. So I'm going to pull up a chart real quick, and I want to go through the process of using this capture software. If I click on the red button and I hover my mouse over just one chart, it's going to take a picture of only one chart. The way we teach in this classroom is two charts, a large chart and a small chart. So I'm going to go to the upper left-hand corner of my large chart. I'm going to left click on my mouse and drag it all the way down to the bottom of the right. I really want to be sure that I get timestamps in there so that I can line up the two charts, as well as the prices so that I can line up the two charts. So when I release my mouse, it's going to give me the ability to capture an image. And if I click capture an image, it's going to provide me this image preview. And guys, this is how conversations happen in the room. This is how you and I are going to have a talk about everything that you see. Because the goal of the classroom is to be able to take your charts with you telling me what you see and me offering feedback from an indicator reading standpoint. So annotation of the chart is key. And guys, accurate annotation of the chart is key. So you could use these shapes. Maybe you're curious about these magenta lines and what they mean. You can use arrows. Maybe you're wondering if this is an area that's been broken or that it hasn't been broken. But the most important tool that you can use, guys, is this call out button. And on your call out button, I want you to tell me what you see, right? How do you read your indicators? Um, and why you did what you did. And let me stress this right now, guys. There are no wrong trades. Everybody's trades may look different, and none of them are wrong. They're just different, and that's good, right? Let's embrace the diversity of trades. But if every time you annotate a chart, you tell me why you did what you did. You tell me what about those indicators made you make the decision that you made. You and I can have a conversation because you may have an instance where everything says down and you chose to take a long trade, or everything says up and you choose to take a short trade. And we can talk about how fighting the trend, or we can talk about the immediate momentum. So the better you annotate your charts, the more information that you give me on your charts, the easier it is for me to provide you feedback. And I had this little, and I'm going to warn you guys right now, I'm horrible with analogies. But I was talking to a buddy of mine over the weekend, and he's a chef. He's a professional chef. He's owned a couple restaurants. And his process for creating a menu item is trial and error. He'll add a little more, he'll take a little more, and he'll keep going through this process until he gets the result that he wants. And he told me, he goes, once I get the result that I want, then I don't deviate. And right now, guys, we're all chefs in the room. We're going to try everything. We're going to try a little bit of this and a little bit of that, and we're gonna go here and we're going to go there. And the idea is that we are keeping it simple and focused on rules that provide a statistical advantage. If you annotate your charts every time you take a trade, it creates a repeatable scenario. This is what I saw, this is what I did, this was my result. Therefore, I can repeat this result if it brings me a statistical advantage. So once you have everything on your chart, just click the copy button in the bottom right hand corner and bring it over to the chat room and drop it in there. And then the way this classroom works is we spend the first hour talking about rules, and we will spend the second hour and beyond um, just talking about your charts, talking about what you're putting in the room. It is scary at first to post your charts in the room, right? What if I'm wrong? What if I make a mistake? What if this isn't the right trade? Then it's perfect because you will learn more from making a mistake than you ever will just getting lucky and watching that P&L rise. Because we want to make sure that you're trading rules, guys. So you're going to post your trades in class. I want you to post everything that you see in class over and over. And I don't want you to hesitate. You can't post too much. You can't ask too many questions. Your understanding is always my goal. Next, you're going to use your spreadsheet. Your spreadsheet is in the Nexgen Study Picks plan folder. And again, this was downloaded on your computer when you got the software. You already have this. But this spreadsheet is just a trade journal. Every time you take a trade, you have the opportunity to put it into this first page. And there's a list of questions. It's going to ask you about the rules. It's going to ask you what you saw. It's going to ask you how you felt. And it's going to give you a place for notes to write down what the result was. And I always encourage people every morning, study what you did yesterday. So if I take 5 trades today, tomorrow morning I'm going to set aside 5 minutes and I'm going to look at yesterday's trades and I'm just going to ask myself what worked. Because the things that work are the things that I want to repeat, right? And what didn't work. This is going to help me avoid pitfalls trading in the new day because I can take yesterday's mistakes and apply them to the day. What felt easy will typically coincide with what worked, and what made you nervous is typically going to coincide with what didn't. So I think it's important to drop that in there to those comment sections so that you can gauge how you're feeling based on what you see. But this brief historical study each morning is going to prepare you for the day. It will accelerate the learning curve. And if you're embracing the path, if you're using the chat room 15 hours every day or 15 hours every week, live feedback on everything that you see, everything that you do, every rule that you're learning, making sure that you have that understanding. Guys, that's available to you every week. Take advantage of it. Be selfish with your time. We're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. This is the first hour of every classroom. We're laying down a solid foundation so that you can become a chart reader, and then your chart reader will take you places that you never even imagined. Your chart reading will add trades. It will create pattern recognition. But we have to start small first. So you're going to simulate your trades daily. The idea is that you're going to post your pictures in class until you're sure you have the correct rules. You want to make sure as a brand new user that you're doing your best to follow the rules that are placed before you, because it's those rules that are going to make you a chart reader, and it's the rules that are going to create consistency. The rules that I teach for the high probability trend trade create a statistical advantage. They're a trade that typically wins 70 to 80% of the time. It's a trade that gives you a path to success while you learn to become a chart reader. We're going to simplify um, two trades in your plan. We're going to start with a high probability trend trade. That's going to be our focus for the first hour. And then we're going to talk about what are called medium probability scenarios. And if a high probability trade, every indicator on every chart agrees for the trade, a medium probability trade means that maybe there's something wrong. Your ability to read your charts will allow you to recognize the challenge that's in front of you. Those trades need to be managed assertively, and your ability to read charts is going to allow you to manage assertively. So it's the foundation that you create that's going to allow you to take these trades. I see a yellow arrow coming up on Discord. All right, I think we're good. After class, go do market replay. We had market replay in here. Someone posted some pictures. They went back, retraded the day, fixed mistakes, took the trades that they skipped the trades that they take. Guys, market replay is a great place to work on your plan. If you're looking for a new trade outside of what we teach, market replay allows you to go back and test and practice over and over. And we're just going to repeat this process every day, guys. We're going to learn the looks so they become easy. Repeat the process every day. Recognition comes through repetition. And then once you, that's when you start looking for those prop firms. That's where you test your plan on a prop firm. The days of needing 10, 15 grand to be a day trader are over with these proprietary firms. They're going to allow you to test your plan, to trade their money, to keep 90% of the profits. It's really a great deal. But we're going to focus on the high probability trend trade. The high probability trend trade is only 3 rules. Remember, we're going to keep it simple. And for those of you that are brand new in here, I saw Snorri's in here. Welcome back. Um, Atif, I see you in here. Welcome to the classroom. We're going to keep it simple in the beginning, guys. Only 3 rules, and each rule is designed to provide you an advantage. And it's the 3 advantages coming together that produce a trade. So a trade is momentum, it's a clear path, and it's an inch. That's the recipe for a trade. And these 3 rules are going to happen on only 2 charts. We use a large chart and a small chart to teach this high probability trend trade. Your large chart, streaming is occasionally stuttering. John P., I saw it on my end too. I saw the yellow arrow pop up. If you guys lose me, let me know. If the video goes away, let me know. If the sound goes away, let me know. I don't know if it's an internet problem on my end, which I suppose the potential is always there, or if it's Discord doing something. So guys, just keep me in the loop if things go a little sideways. Oh, no problem, Snorri. Just be safe. That's the key. Be safe. Your large chart is going to define direction, momentum, and areas. Your large chart leads the way. Your large chart is going to tell you whether or not it's time to look for a trade. The large chart behaves as a very broad stroke of a brush. It is going to take the general opinion of the market. What the large crowd is making happen, the large chart will reflect, excuse me. Your first two rules for a trade must be true on the large chart. Rule number one is going to give you the advantage of momentum, and rule number two is going to give you the advantage of a clear path. And all of this happens on the most current bar on the large chart. When these rules are met, we're going to turn our attention to a small chart, to a faster chart. This is a refinement chart. And you're going to take that broad stroke of a brush that the large chart creates, and you're going to pinpoint an area for entry using rule number three, using a limit order to buy or sell a pullback at an area. Good morning, PFI. And by doing so, it's going to allow you to reduce your risk. It's going to let you maximize your profit potential. So those two charts, I always like to show this picture. Your large chart is what the large crowd is doing. These are the market movers, guys. These are the ones with the deep pockets. These are the guys that are creating trends, that are creating momentum. These are the people that are reacting to those Fibonacci areas that may stop or bounce the market. And this is what leads the way. The large chart has to have your rules true. And when they are, there's going to be a small crowd. There's going to be people that fight that trend, that fight that momentum, and they're going to create a small little pushback, what we call a retracement. And next-gen users are going to pinpoint using a small chart exactly where that retracement should happen. And this becomes your entry for the highest probability trend trade. So keep it simple at first, guys. For 20 days, or even just a week, right? Focus on entries. Focus on getting into the market at the correct spot. We're going to use just a very simple path. We're going to focus on these three rules and the advantages that they provide. Um, and the advantages start with the T3 trigger lines. Your T3 trigger lines are two parts, and I'm going to go ahead and bring up a picture that lets you identify them. Whoops. So your trigger lines consist of small triggers. Whoops, I keep going to the wrong picture. There we go. Small trigger lines, which are these solid lines. There's two lines to create the small trigger lines. And the large trigger lines, those dashed lines. And then again, there's two lines that create those large triggers. So these work together, these small and the large. And the first thing that they're going to do is they're just going to help you identify the trend of the market. When the small trigger lines break above the large trigger lines, your background is going to paint green, and that green background lets you know that the odds are favorable, or I'm sorry, that we're in an uptrend. The market is moving up, the smalls are above the large, that background paints green, and it allows you to only look for trades that follow that trend, for the rules to be met for high probability trend trades long. When the small trigger lines break below the large trigger lines, it'll paint that background red, and that red background lets you know that we're in a downtrend. You're only looking for rules to be met for high probability trend trade short. So really the first advantage that you can give yourself before you even start looking for rules to be met is the simple commitment of trading with that overall trend, that large chart trend. And then once you have it, we're going to make sure that we have strong trigger lines. Rule number one says that we must have strong trigger lines because when we do, it's going to provide us the advantage of momentum. So strong trigger lines in an uptrend mean that your small triggers have broken away from and above the large triggers. Both sets of triggers are wide and angled in the direction of the trend. It's that separation between the small and the large that lets me know that the odds are favorable for the market to continue in the direction of the trend. So our advantage of strong triggers begins when the small triggers separate, and it ends when the small triggers return. And during this point, that strong trigger, that odds favorable momentum point, we are going to have the most favorable conditions for buying a pullback to Fibonacci support on a smaller, faster chart. On your large chart, those pullbacks look like these tails or these wicks. But with that refinement process for entry, we're going to be able to pinpoint right where that tail is most likely to form, and this becomes your entry for that highest probability trend trade. In a downtrend, the small triggers and the large triggers are both wide and angled in the direction of the trend, and it's that separation between the two that lets me know that the odds are favorable for the market to continue down. Odds favorable momentum is something that you're going to hear in class all day long. Did you have odds favorable momentum getting into this trade? Did the odds favorable momentum suggest that the market was likely to push? And when you have it, this is your advantage. And in a downtrend, that's when it's most favorable for selling that pullback to Fibonacci resistance. And again, it'll look like those tails on a large chart, but you'll be able to pinpoint where that tail is most likely to form and take your entry on a smaller, faster chart. So the commitment to strong triggers should be the first commitment that you make to your trade, guys, getting that advantage of momentum. Is everybody comfortable with that look? This one's usually pretty easy to recognize in the moment. That separation between large and small, everything in the same direction. Guys, that's the advantage of momentum. And if I go back to my S&P, there's a beautiful example of it. That's a strong trigger look. That's a strong trigger look, right? And look, there's one of those potential tails. So those strong trigger looks lead the way. And we stick to that momentum because when your small triggers work their way inside of the large triggers, we call this a weakening of the large triggers. And when you have weakened large triggers, anything can happen up or down. It really becomes kind of a crapshoot, right? The odds are favorable for the market to continue. Anything can happen up or down, and you're going to see that anything can happen up or down look. It typically precedes a reversal. And it typically precedes price getting to those key Fibonacci areas. So this picture kind of illustrates rule number one. It reminds you that 90% of what you do during the day is reading your indicators, waiting for those advantages. 10% of what you do is going to be taking advantage of the momentum, the clear path in the entry area. So it starts odds favorable on the left and works its way into anything can happen, and that's where the market reverses, giving me odds favorable momentum. There's one of those tails, and the market pushes up, right up to anything can happen triggers. Once again, those weak and large triggers. That precedes the reversal, which gives me odds favorable momentum and an opportunity to continue with the trend. This is going to repeat itself throughout the day. You're going to go from odds favorable to anything can happen. And sometimes your trigger lines just aren't going to agree at all. Sometimes you're going to see the larger down, the smaller up, or maybe your background is green, but your trigger lines are going the wrong direction and they're red. This is where people that don't have the advantage of rules, the people that don't have the advantage of Nexgen and Fibs, this is where people get caught up in consolidation. And I know that if you've traded at all, you've probably been caught in consolidation. When rule number one isn't met, there's a fight between buyers and sellers. And they're battling for supremacy at that point. One of them's going to win. We don't have to predict who. We just simply sit on our hands and wait for the advantage to return, to get back to that odds favorable momentum. So that's rule number one. Rule number one is going to set you up for success by giving you the advantage of momentum. And then once you have it, we're going to stay on that large chart, and we're going to make sure that there's nothing in the way, that termination conditions are false. And Dwight, this is going back to making sure that there's nothing between you and your target, and that's what termination conditions are. Termination condition is just an area that may reverse the market. The areas can be Fibonacci resistance, Fibonacci support. It can be those yellow 1-to-1 dots, or it can also be a divergence high line, that magenta line that's going to print from a pivot when there's a loss of momentum, or a divergence low line, that cyan line that's going to print from a pivot when there's a loss of momentum. So we're going to use these areas, and it becomes a pretty simple recognition process. We're going to just do a comparison. And I'm going to show you the comparison right here. The first thing that happens to determine whether or not an area is likely to stop the market, and remember that these Fibonacci areas are the areas where the deep pockets investors are reacting. They know they're there just like you know they're there. And they have the potential to create bounces. They have the potential to reverse markets. So when price, these dynamic Renko bars come down and reach Fibonacci support, that's the first part of the process. Price reaches the area. When they reach support, all you have to do is ask yourself, where are my trigger lines? If your trigger lines remain above support, you've reached a termination condition. You're in an area that may create a reversal. It may create an untradeable bounce. And the reality is that we don't know. We don't know in the moment, right when it hits that area, whether or not it's going to hold or whether or not it's going to break. So rule number 2 says don't trade into termination conditions because it robs you of the advantage of a clear path. So if we can't trade into a termination condition, when does the path become clear? There's two options when you reach a fib. It's either going to break or it's going to reverse the market. And we consider an area to be broken. Up here you see Fibonacci support when both the small and the large triggers make it to the other side of that area of support, it begins to act as resistance. So small triggers and large triggers get below support. The area is now broken. The path is clear. And you'll notice that there's that odds favorable momentum. We now have a clear path, and here's a pullback right to Fibonacci resistance. There's your potential entry for the highest probability trend trade, taking you all the way down to Fibonacci support. So for brand new users, I want you to allow it to be very simple. I want there to only be two scenarios that you're looking for. And let me find my two-picture look. Hey, Chef, welcome to the room. If price reaches the area and the trigger lines remain below, the area is not broken and the path isn't clear. Guys, this is rule number 2 not being met. This is forfeiting the advantage of a clear path. When the small and the large get to the other side of the area, now the area is broken and now the path is clear. So really pretty simple in the beginning, guys. We're going to let price reach the area and then we're just going to gauge where the trigger lines are. And if we go back to the live market once again, you'll begin to see instances where price reaches resistance and the triggers can't break and it creates a bounce. Price reaches resistance, triggers can't break, creates a bounce. Fibonacci resistance with no triggers through, that termination condition causes the reversal in the market. And if you scroll back, you're going to begin to see just how often Fibonacci can stop the market in its tracks. So two-part process. Price reaches the area. Trigger lines remain below, no long trades. It's really that simple. Price pulls all the way back to support. Triggers remain above. No short trades. 90% of what you do during the day will simply be waiting for those advantages, waiting for the absolute best of the best, because your money is worth the best of the best. From support, price pulls back up to resistance, back up to that divergence high, and you'll notice that absolutely none of the trigger lines have broken through the area. Hey, Chef, good looking picture. Perfect. And let me show you what it looks like when it comes up on my screen, because what I'm going to do is I'm going to take your pictures and I'm going to open them up on my end. And that one doesn't appear to be opening. Let's see if I can click the link. There we go. And it gives you a great opportunity to see everything that we're doing. And remember, when you're looking at your charts, guys, you can hit that full screen, make it a little bigger down here. You can also take this and slide it over if it appears to be too much. Good morning, Jose Trades. Price reaches the area, trigger lines remain below, guys. We now have a termination condition, and look how it reverses the market. Your large triggers go from green to red. Your smalls get below the large. There's separation, and there's one of those little tails, one of those potential entries. When a termination condition reverses the market, we're going to call it a strong top or bottom. So here we have what's called a strong top, and this is going to be the precursor for your highest probability trend trade that you can take, that trade that typically wins 70 to 80% of the time. From a low, price reaches one-to-ones, all of the trigger lines remain above. The recipe is consistent every time. If this termination creates a full reversal in the market, well, now we have a strong bottom. Notice that the large triggers go from red to green. You get up bars and down bars. All of this is that fight between buyers and, between buyers and sellers. Sellers are in control right to the termination condition. The buyers try to push up, but the sellers fight, and the buyers push, and the sellers fight. We don't have to get caught in the middle of this, guys. If we wait for that condition to change, right, to go from indecision and fighting to smalls above the large, larger wide, everything is clear, there's that potential entry. There's that patience piece waiting for the best of the best to get you into that highest probability trend trade to take you off to the next area. And guys, this is what we focus on every day. Sometimes the market doesn't reach an area. Sometimes the market has odds favorable momentum and seems to turn from nowhere. I'm going to give you one more termination condition. This is the only termination condition that I give any credit on a smaller, faster chart, and that's three divergences in the same price range. A divergence is a loss of momentum. You can identify a divergence by a cyan line printing from a low or a magenta line printing from a high. One divergence on its own, small chart, large chart, means nothing in the grand scheme of things other than there was a loss of momentum. That's it. But when you see three divergences in the same price range, those three losses of momentum, guys, this is powerful. This may reverse the market. This may change the trend. This may create a pushback that is going to take you beyond your entry rules. So three divergences from a low or three divergences from a high may terminate a trend. When that third divergence has those anything can happen triggers. Remember the smalls inside of the large, that weakening of the large, letting you know that anything can happen up or down. These three divergences become more powerful with that look. And then they become more powerful still when that third pivot from a low is higher than the previous, or that third pivot from a high is lower than the previous. Now we have a head and shoulders pattern. So guys, you're going to see this look at a low or this look at a high when your large chart may turn, but it moves too slow to give you that information in the moment. So you may see three divergences down here, keeping you out of that last short trade, or you may see three divergences up top, even with that odds favorable momentum, letting you know that the large chart's changing its mind. These three divergences also become very beneficial as you learn to manage your trades, because if you're in the perfect short, and three divergences print, it allows you to get out to preserve your equity, to manage your risk. Same thing with a long trade. If you're in from right here, that third divergence is going to have you out break even rather than with a loss. The idea is that we never trade on hope or emotion. We keep it pragmatic with these rules, and these rules are going to take the emotion out. It's either the rules are met or they're not, right? So if we have momentum, we know that we have those strong triggers. That's our first advantage on the large chart. And if termination conditions are false, if price hasn't reached an area, and there's room to the profit targets, then we know we have a clear path. These are recognized on the higher time frame. These are recognized on that large chart. Smalls below the large are wide, right? We know we have odds favorable momentum. We can see that we're in a downtrend. If I go to crude oil, larger down and smalls are up. Indecision. We don't know who's going to win. Is it going to be the large chart or the small chart? Or the buyers, the sellers? But we do have all the triggers below resistance. But here's our look, guys. There's that termination that creates a full reversal. That full reversal gave you odds favorable momentum, and there's one of those tails. And we're going to go through the process right now of identifying your perfect entry on that smaller, faster chart. And when I come back, after we talk about the rules for entry, you're going to see just how amazing this trade was. Live in the crude oil market, guys. Rule number 3 says that we're going to use a limit order to buy or sell a pullback on a smaller, faster chart. Remember that pullback is just a small retracement of price, just that little retracement of price, counter to the underlying trend. When the large chart has momentum and a clear path, we're looking for a little pushback, a small retracement in price on that smaller, faster chart so that we can pinpoint the area where the market is likely to continue. So when the rules say go on your large chart, your small chart's going to look like this. Everything says up. You should have strong triggers, and you should have what we call favorable large triggers. And favorable large triggers mean on your smaller, faster chart that both your large and synthetic triggers are wide, they're angled in the direction of the trend. The smooth large triggers are native to the 5-1. The stepped synthetic triggers, those are your 13-2. Those are your large chart large triggers. And these two work together. There's a symbiotic relationship there. When they are one on top of the other, overlapping, it's going to create your absolute smallest window of opportunity, that smallest point where the market is likely to continue. And this is going to allow you to reduce risk. This is going to allow you to maximize profit potential. So rule number 3 is going to have us buying or selling a pullback, that small retracement in price, at an area inside of these favorable large triggers. And you're going to be able to pinpoint it before it ever gets there. And you're going to be able to do that so well that you're going to wait for the market to come to you with a limit order. So when everything says up, when your large triggers, your synthetics are up, they're wide, we're going to identify our areas. High probability trend trades always come from a line. The 3 lines inside of favorable large triggers that we look for are fibs, mid bands, and yellow 1-to-1s. Those become our bounce point for that high probability trend trade, that bounce point for the trend to continue. But we need to wait for the pullback. And your pullback begins with a reversal bar on your smaller, faster chart. And at the time of the pullback, all you need to do is identify your window of opportunity, that point where the market is most likely to continue. You can do this using a drawing tool. You can do it in your head if that works for you. But for a high probability trend trade, your window of opportunity for a long trade is going to be from the lowest point of support, or from the highest point of support, excuse me. The highest point of support inside of favorable large triggers to the lowest point of support inside of favorable large triggers. This is your long trade look. This becomes the area where the market is most likely to bounce. And then for a short trade, it is from your lowest point of resistance to your highest point of resistance inside of those favorable large triggers. And that's the key, guys, is we want them inside of those triggers. That's the most likely spot for the bounce. That is where 20 years of study has told us that's where the market is most likely to continue. So at the time of the reversal bar, from your highest point to your lowest point, this becomes your window of opportunity. You're going to activate your limit order right at the top of that window. And this is where what happens is no longer in your hands. This is where what happens is out of your control. If the market pulls back to that highest point of support inside of favorable large triggers, it's going to hit your limit order. You're going to be in a long position. Guys, you're going to be in a long position with the advantage of momentum because your large chart had strong triggers. You're going to be in a long position because of a clear path. Your large chart did not have termination conditions. And you're going to be in that long position with the advantage of having entered the market where it's most likely to continue. And this is your high probability trend trade, guys. 20 days focusing on entries. Just getting great at the reads, getting comfortable with the idea of trading with the trend, with the momentum, with the clear path, being able to identify that area of opportunity. Guys, this is going to be your focus for a couple weeks just so that you can get good at it. Couple things to think about it. We enter at the top of the window because of the momentum on the large chart, because there's nothing in the way to create a bounce on the large chart. So we're going to enter at the top of that window, but I want you to go into every trade with the understanding that it may go to the bottom of the window because it is an area, right? It's a window. So we'll enter at the top because of the conditions on the large chart, but we'll fully expect that it may go to the bottom because it is a group of areas from a high point of support to a low point of support. And then guys, one of the great things about Nexgen, with the precision that we identify where the market is likely to continue, is we can also identify our risk. If the market continues beyond that window, you'll place a protective stop beyond that window. And if the market continues through the window, it's going to hit your stop. It's going to pull you out of that trade. And this is how we manage our risk before we ever manage profits on a trade. We know where it's most likely to continue, and we can identify that window by looking first for the large triggers and then refining it even smaller inside from the highest point of support to the lowest point of support. Your stop goes beyond the window. Is everybody comfortable with this? Give me a Y in the room if you're with me. We get in at the top because of the momentum, and we put a stop beyond. Because anything that wins 70 to 80% of the time, do I have any math people in here? What's the other side of that coin? 20 to 30% of the time, the market's going to be wrong. 20 to 30% of the time, your stop's going to get hit. If you take this trade 10 times, you're likely to lose two or three of them, right? I want you to get that in your head and be okay, be comfortable with it. It's a cost of doing business. The whole idea to being a rules-based trader is that every time you enter a trade, you have a statistical advantage. You have a definable, a repeatable, a testable pattern that has been proven to win more than it loses. Guys, this is your high probability trend trade. This is your focus for your first 30 days with Nexgen. You're not going to be $1 million trader in your first week, but if you focus on these three simple advantages, if you focus on that one great entry, it's going to give you the opportunity for success to have a plan that typically wins more than it loses. And then from that plan, as you learn to read your charts, it's only going to expand. Things that new users typically do. I like to point this out as we get into entries. Your small chart is exactly that. What happens in one bar on your largest chart is going to happen in 15 to 30 bars on your smaller, faster chart. And there will be fluctuations on that chart. See this one bar? All of these bars happen within that one bar. Notice that it goes up, it goes down, it goes up, it goes down. But we're focusing on the advantages of that larger chart. So don't get caught up in the fluctuations. Don't get caught up focusing on your small chart when the large chart leads the way. Because if you do, you're going to find yourself entering the market at the top of this bar, fearful that it's going without you. I see this a lot with new users. It's very common. If you do it, I don't want you to beat yourself up about it. I've done it myself 1,000 times. This is typically the first trade or the first entry as you get worried that the market's going to go without you. Because you'll see that fluctuation and you'll have that moment, that fear of missing out. Waiting for down here is always your best because what have you done? If you jump in early, it doesn't guarantee a winner. What it does is it guarantees a larger loser if this is one of those trades that doesn't win. The other side of the coin is that you have shortened the distance to your target dramatically. So not only have you increased risk, but you've reduced your profit potential quite a bit. So your first 20 days is developing trust on the best of the best entry. It's developing trust in the methodology. It's developing trust that more often than not, it's going to make it to that area. And if it doesn't, well, then it's simply not your money. The next thing I see with new users is getting a little bit fearful because their small triggers turn against them. Small triggers on a small chart are a very fast moving momentum indicator. And without a loss of momentum, without them turning against you, it's probably never going to make it down to that area inside of favorable large triggers. Notice that they're still outside of the large, that everything still says up. And of course, guys, I want you to remember that while those small triggers might be turning on a smaller, faster chart, your large chart still has odds favorable momentum, and your large chart still has a clear path, and that's the chart that leads the way. But this is a trade that I will take 1,000 out of 1,000 times. This is the trade that I never want to miss because 70 to 80% of the time, this is a trade that typically wins. This is a trade that gets to that profit target. This is the great entry that creates manageable trades. And guys, this is our focus for the first 20 days, this simple approach to finding the absolute best of the best trade. And remember, we looked at crude oil a little earlier. And we had that termination that created a full reversal. And we had that odds favorable momentum. And we hadn't reached our area of resistance. Remember I said you would be able to pinpoint where that tail is most likely to continue? Look at my smaller, faster chart. Price pulls back directly to the area of support inside of favorable large triggers. Guys, this is your trade. This is your setup. Would you like to do an entry together? Let's get all the noise off. Let's go through the process of recognizing that best of the best. Let's go through the process of recognizing odds favorable momentum, no termination conditions. Large chart leads the way, guys, and I took all the areas off the large chart. I want you to focus. Was it PFI? Let's look. Let's see. Strong triggers, right? No termination conditions. So, Atif, Walter, are you guys good with this? Sydney? Who else is new in here? Hey, Chef, Walker, guys. Smalls above the large are wide, they're angled in the direction of the trend. Rule number one has been met. Price hasn't bounced into one of those Fibonacci areas, so I have the advantage of a clear path. Guys, at this point, my large chart is done. It's told me that it's time to look for a trade. So I turned my attention to the smaller, faster chart. Let me get this cheater circle off of here. I turned my attention to the smaller, faster chart, and on the smaller, faster chart, I'm waiting for a reversal bar. I'm waiting for something to signal the beginning of a pullback. And as the market goes up, I'm saying, hey, there's a mid band and there's Fibonacci support and my triggers are up and everything's strong. And I just need a reversal bar. And there it is. And at the time of this reversal bar, your goal for the first couple weeks, guys, is to identify from the highest point of the trigger lines to the lowest point of the trigger lines. And then the areas of support within. So your window of opportunity goes from the highest point of support to the lowest point of support. Is everybody comfortable with that? That's about an 11 tick range. Typically, you're going to have approximately 12 to 14 ticks of risk on a futures trade, guys. I'm going to right click on my chart and I'm going to activate, whoops, wrong one. And I'm going to put the wrong line on it. I'm going to activate a limit order a couple ticks above that area of support inside of favorable large triggers because everything's moving up as the market moves down, and I want to be a tick or two higher because I don't want to miss this trade. And then the market's going to come down. Oh, it went up. And this is where you're like, oh my gosh, it went up. What do I do? And sure enough, there's another reversal bar, and now it begins to move down, and you may have to move your order as that mid band comes up to stay a tick or two above. And here it comes, and here it comes, and you're now in a long position, ladies and gentlemen. You're in a long position with the advantage of momentum. You're in a long position with the advantage of a clear path. You're in a long position having entered where the market is likely to continue. Guys, for futures trading, my initial stop is typically 12 to 14 ticks, which means that I'm somewhere right about here, below those large triggers, outside of the window of opportunity. Give me a Y if that makes sense, especially you, PFI. I'm going to give it 12 ticks. I'm going to go 4 or 5 ticks outside of those large triggers. I'm going to make sure that I give it a little room to breathe because I'm not in control of the market. I'm only in control of the patterns. Whoops. Bum, 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 bum. So the market comes down. That's okay. You're building trust. I'm in the trade. My stop's in place. I have every advantage. This is a great looking trade. In the market, notice how it comes lower. But the large chart leads the way. The large chart is strong. The large chart has no termination conditions. And there's your reversal bar in the direction of the trend. So PFI, everything's areas, right? Everything. This was your window, ladies and gentlemen. And ultimately, your window was one line wide. One area left inside of those favorable large triggers. I'm going to tell you right now, it doesn't make sense to put a stop 2 or 3 ticks below that line. You're going to get hit 99 out of 100 times. Keep it 4, 5, 6 ticks outside of the bottom of those large triggers. Give it some breathing room. You have to be willing to lose in order to win. You have to be willing to risk money in order to make money. Once this gets a reversal bar, I can minimize my risk below the reversal bar, a couple ticks below. This particular trade, you end up with about $80 worth of risk. 120 to 140 initially, it changes to 80, and the market begins to head off in the direction. And it fluctuates a little bit. And I want you to see all of this nonsense on the small chart. If you're focusing on the advantages of the large chart, it should never phase you. And it will phase you considerably in the beginning because it's hard to watch that small chart fluctuate even though the large chart says go, you have every advantage. And guys, that's your entry for the highest probability trend trade. And it will PFI, and it will because you're brand new, right? So what are we doing? We're developing trust. We're developing the ability to read our charts. There's a section on your spreadsheet that says my personal trade setup looks. Your rules-based trade. And look at that. Here's your perfect setup. Strong triggers, no terminations, identifying the area inside of favorable large triggers. Since price hasn't reached this Fibonacci area, that's a target, not a termination. Guys, this is your best of the best. Your job for the first 20 days in PFI, your job is to fill up your spreadsheet with the best of the best looks, to develop trust in that momentum, develop trust in that clear path, to develop trust in that best entry so that you can take it and your palms stop getting sweaty, right? And your heart stops racing and you quit leaning forward into your screen. That's the goal for every new trader, guys. And this is a process. I'm going to give you my spreadsheet right now because my spreadsheet contains about 250 entries. Most of them fit the rules 100%. Some of them don't. These are the client's perfect trades, not necessarily mine. But you'll find that most of these trades revolve around the exact same rules. The idea that odds favorable momentum and a pullback to an area are a recipe for success, excuse me. You're going to see, once again, go in the other direction. Small's above the large are wide, they're angled in the direction of the trend, and it pulls right back to support inside of favorable large triggers. So what you're doing is you're learning these looks, you're learning these rules so that it becomes easy, right? That's the second step in your path to success. Third, simplify what looks are you going to commit to. You must learn them so that they become easy. And then I'm going to give you a high probability trend trade checklist, guys. You can print this out. You can put this on your desktop. Every time you take a trade, you can take a look at this and make sure that your advantages are in place. And as you learn them, these help police you a little bit. Is the market coming from a good top or bottom? Is it an area that created a full reversal? There's a video attached to make sure that you're comfortable. Do you have odds favorable momentum, those strongest trigger looks on the large chart? Do you have no termination conditions on that large chart? And did you get it at the area inside of favorable large triggers, guys? If you follow this checklist, I've never had anybody do worse than 70% winners. But there's a lot of patience involved, right? Because the high probability trend trade may set up 3 or 4 times a day. But the reality is that if you take 4 trades a day and you win 3 of them, you're making money for the rest of your life. And that should be your goal, is to make money. So do it with a trade that has a proven statistical advantage, especially as you're learning to read your charts. I just put that into the room for you. I'm also providing you the exact same checklist with pictures stolen from the resource material. Is the market coming from a good top or bottom? Well, it's a termination that creates a full reversal. You can identify it. Do we have odds favorable momentum? Here's a picture telling you exactly what it is and also reminding you exactly what it is not. We're not trading opinions, guys. We're trading patterns that are proven to win more than they lose. There's your termination conditions, and there's your window of opportunity. So I'm going to give you this checklist as well. Do you notice that everything that I talk about is sequential? That we're not talking about, hey, let's focus on the trade. What we're saying is, let's focus on the individual pieces of a trade that create a trade. Identifying your trend is going to be the first thing that you do. So if you're brand new in this room, right, you should be able to look at your large chart and determine, are we in an uptrend or are we in a downtrend? Let's go look, guys. I have a lot of open windows. Goodness gracious. I'm going to go to the most current bar. Guys, are we in an uptrend or a downtrend right now? New users, help me out. What color is the background? If the background is red, we are in a somebody, anybody. Remember, the more you participate, the quicker you're going to get to where you want to be, guys. That's okay. We're in a downtrend. Thank you, Walter. So once we identify that we're in a downtrend, and this is how I look for every trade that I take, ladies and gentlemen. I'm in a downtrend, therefore I'm looking for rules to be met for high probability trend trade short. So I need to make sure that my strong triggers match that look. This is the second piece of the puzzle. I'm in a downtrend. Do I have strong triggers to the downside? If the answer is yes, and only if the answer is yes, well, then my next piece of the puzzle is making sure that I have a clear path, making sure that there's nothing in the way. Guys, trend will take you 8 seconds to be amazing at. Unless you're colorblind, then you'll have to use the trigger line position. Trend is easy. Strong triggers most people have by the end of the first day. That's half the way to an entry already on the first day, guys. And then we start talking about those termination conditions, those clear paths, making sure that price hasn't reached an area. And this may take you 4 or 5 days to really get comfortable with. But that's the third piece of the puzzle. I want you to pretend that we're eating an elephant. And if you just say, I'm going to find an entry, it's overwhelming. But if you say, I'm going to take the trend and couple it with momentum and make sure that my path is clear, once you get this big, guys, your large chart analysis is done. You're a chart reader. And then you just focus on the best of the best entry. And that's the fourth piece of the puzzle, guys. In your first couple weeks with Nexgen should be going through that process. The trend is down. Smalls are, in fact, below the large. There's the second piece. But price reached Fibonacci support and all the trigger lines remained above. Therefore, no short trades, and I have to go back to being patient. I have to wait to see, is this area going to break or will it reverse the market? I have no idea. I'm not in charge of the market. I'll never be in control of what the market does. So go through the process and use the checklist. And then, guys, whoops, I'm going to give you one more gift. And this is a plan for consistency, guys. One of the biggest things that I admire about some of the traders with Nexgen, people that have traded Nexgen forever, that are successful daily, that make a living doing this, is that their plans are simple, they're focused, but most importantly, their plans are written down. They're in a position where they take the same trade every time because of the statistical advantages. They leave